Hey, what is going on, guys? My name is Nick, and in today's video I'm going to be sharing 3 somewhat popular stocks that have fallen recently, but I am not going to be buying on the dips. And I want to give credit to Daniel Pronk for inspiring this video idea, where he also discussed 3 stocks he would not buy, so make sure to check out his video too. Now, as a value investor, you know I'm all about buying stocks on a discount because it can present some of the best buying opportunities in our highest conviction stocks for the long term. But just because a stock drops in price does not mean that it's on sale. Sometimes investors become way too optimistic about a company or an industry, and so they'll bid the stock price to the moon, whereas the company might not even be making profits or sales, as we'll see with one of the stocks in today's video. But other times, a company's fundamentals or future outlook change, and therefore a lower valuation is then justified. In many of these cases, investors might find these stocks undervalued on any dips, when in reality they're actually value traps. So in this video, I'll be sharing 3 stocks that are down big recently, but I do feel that they are value traps. So if you enjoy, make sure to drop a like on the video, as it does really help me out, and I put a ton of research into this one, so I hope you enjoy. Also, if you haven't already, make sure to subscribe so you don't miss any of my future uploads. And I also just want to thank the Daily Upside for sponsoring today's video, but more on that later. Alright, now the first company that I will not be buying on the dip is Rivian, with ticker symbol RIVN. For those who aren't aware, Rivian is a new and upcoming electric vehicle company that has seen a huge 18% investment from Amazon, and many investors assume this company will be the next Tesla. For this reason, the stock peaked at $172 per share soon after its IPO back in November 2021, when a lot of hype was surrounding the EV sector. But more recently, the stock is down over 60% to about $65 per share, being a market cap of around $60 billion. Now, if I'm being totally honest with you guys, even after this massive 60% drop in the share price, I still think this might be one of the most overvalued stocks I've found in the entire stock market, and here's why. To start, we can see that Rivian produced 1,015 EVs throughout 2021, while they only delivered 920 by the end of the year. And before 2021, the company had 0 track record of production. And for this reason alone, Rivian should not be compared to Tesla, which has a decade of production experience and delivered over 936,000 EVs in 2021 alone, being over 1,000 times the number of EVs Rivian delivered. And just for fun, if we go ahead and calculate Rivian's valuation based on the number of EVs they've delivered, you end up paying $63 million per EV delivered for Rivian stock. Just think about that for a minute. $63 million per EV. As for Tesla, the market valuation on a per EV basis comes to around $1 million per EV delivered. So if you thought that Tesla was overvalued, this illustrates an entirely different story. So then what would it take to justify Rivian's current valuation? Well, it all comes down to production. Rivian is of course just at the beginning of their production ramp, but there have been rumors that they plan on delivering 40,000 EVs throughout 2022, while they want to hit a target of 1 million EVs per year by 2030. So let's assume the best case scenario where Rivian meets their 40,000 EV delivery targets by 2022, and assuming an average price per vehicle of $70,000, this would give them $2.8 billion in revenue. Well, at the current stock price, this would give the company a forward price to sales ratio of about 20, which I still believe is way too high for a company like Rivian. Comparing it to Tesla, which achieved revenues of $53.8 billion in 2021, the stock is trading for 17 times trailing sales and closer to 12 times forward sales. However, there is a reason why Tesla should trade this rich and why Rivian should not. That's because Tesla is the world's leader in EV sales. It has a decade of EV production and manufacturing experience. It has industry-leading profit margins, it has an energy and solar business, it is one of the world's leading AI technology companies, and it is already generating tons of high-margin software revenue from FSD, which is on the verge of solving full autonomy, among other factors. On the other hand, Rivian is simply an automotive company with next to no production experience, no full self-driving capabilities, no energy business, and no AI expertise, and therefore should be similarly priced to an automotive company like Ford, which is the leader in trucks and has a price to sales ratio of 0.5 right now. We could even assume that Rivian meets their production target of 1 million vehicles by 2030, which would bring in $70 billion in revenue, and based on their current market cap, they have a 2030 price to sales ratio of 0.86, and this is still higher than Ford's price to sales ratio today. So honestly, it's a real possibility that we see no growth in Rivian stock by 2030 based on the current stock price. Anyways, let's now take a deeper dive into Rivian's financial statements. Here we can see Rivian only has 1 quarter of actual data since the company just went public back in November 2021. So for the entire year of 2021, Rivian made a total of $1 million in revenue, Yes, only $1 million on a market cap of around $60 billion. Again, just think about that for a minute. Rivian also had a net cash loss of $776 million, which even excludes the negative impact of senior convertible promissory notes, which brought the total net loss to $1.2 billion in the quarter. And this net cash loss was nearly triple the loss incurred in Q3 2020 of only $281 million, so losses have been getting much worse year over year. As for their balance sheet, we can see they honestly do have a solid cash position of $19 billion, mainly from the proceeds of their IPO only a few months ago. But on their cash flow statement, we can see they've already lost about $2.9 billion in cash in the first 9 months of 2021, which ends up being $3.8 billion annualized, giving them exactly 5 years of wiggle room. However, considering that their losses have increased 2.5 times from 2020 to 2021, it is very likely that these losses will continue increasing quarter over quarter and year over year as they continue to scale production. So I am almost certain that dilution will occur at some point in the near future if they can't achieve profitability very quickly. Overall, I honestly would not be surprised if this stock continues falling if they can't meet their production targets, because in my opinion, Rivian's valuation is absolutely outrageous and it prices in every last ounce of growth until 2030. Alright, now before we get into stock number 2, I want to tell you about today's video sponsor, The Daily Upside. The Daily Upside is a free financial newsletter that delivers some of the most important and engaging stories in business to you before the market open every weekday. So far, the newsletter has gained over 250,000 subscribers to date, and for a good reason. The Daily Upside simplifies stock market research via their 5-minute newsletter, which is actually quite entertaining to read, unlike other traditional financial news outlets. For example, I just read that Disney reported their Q4 2021 earnings and made $21.8 billion in revenue, up from $16.2 billion in 2020, and ahead of the $20.3 billion analysts forecasted. They also gained nearly 12 million new Disney Plus subscribers, beating expectations of 8.3 million, and as a result, the stock price rose accordingly the next trading day. So make sure to click the link in the description or the pinned comment below to sign up for the Daily Upside newsletter completely for free. Anyways, thanks again to the Daily Upside for being today's video sponsor, and let's get back to the video. Alright, now the second stock I will not be buying is a Canadian e-commerce company named Lightspeed with ticker symbol LSPD.TO in Canada or LSPD in the US. You can think of Lightspeed as an omni-channel e-commerce company like Shopify, allowing merchants to sell things online, except they are in the much earlier stages of growth. And to an innocent observer, this company is very interesting, having a very solid stock price history until recently, being down about 75% since their all-time high less than a year ago, since the economy has been reopening from the COVID shutdowns. Along with that, revenue growth has been explosive, where the company just grew its revenue by 165% year over year to $153 million in the most recent quarter. And annualized, this represents $610 million, while their market cap is only $4.8 billion, only representing a Q4 annualized price to sales ratio of 7.9. So despite the seemingly cheap valuation for an e-commerce stock, here's why I am not going to be buying Lightspeed. First of all, Lightspeed is unprofitable and they have contracting margins. Typically, when a company is growing its revenue, they'll see expanding margins because they'll benefit from what's called economies of scale. However, the opposite has been true for Lightspeed over the past 5 years. Back in 2018, we can see Lightspeed had revenue of $15 million and a gross income of $9.2 million, which represents a gross margin of 61%, and that's honestly a solid margin. However, fast forward to 2020 when they were benefiting big time from COVID, Lightspeed had a gross margin of 41%, which represents a drop of 2,000 basis points since 2018. And exactly 1 year later in this past quarter, Lightspeed now has a gross margin of 33%, which is a drop of 900 basis points year over year. Overall, this means that the company is struggling to achieve profitability since their cost of goods sold are rising faster than their revenues are, which is not a good sign. So the question then becomes, when will the pain end? Like, when will their margins start steadying out and reaccelerating? Well, I'll leave that up for you to decide. Reason number 2 why I'm not buying Lightspeed stock is because they're diluting shareholders aggressively. Here we can see that throughout 2021, the company's outstanding shares increased from 110 million to 148 million, representing 35% dilution year over year, and this is massive. And the main reason behind all this dilution is Lightspeed has made 3 massive acquisitions in 2021 totaling $1.3 billion. Now, dilution for acquisitions isn't necessarily a bad thing if it adds value to the shareholders, but as we saw earlier, Lightspeed's margins have been compressing since 2018, and I would bet that's a result of several acquisitions they've made in the past. Also, these acquisitions are fueling Lightspeed's growth tremendously, where they grew total revenues by 165% year over year, but only by 74% organically, which is certainly something to keep in mind. They also forecast to see 35 to 40% organic revenue growth moving forward, which is a significant slowdown from the 74% they saw in 2021. Thirdly, Lightspeed has a whole lot of goodwill on their balance sheet, which Peter Lynch likes to call a phony asset. Goodwill is an intangible asset on the balance sheet where a company earns it after acquiring another company above its book value. Here we can see Lightspeed over doubled their goodwill in the past year, which means they've done some expensive acquisitions to achieve this. And as we can see, Lightspeed's goodwill of $2.1 billion represents over half of their total assets on the balance sheet, only being worth $3.7 billion. So guys, think about this. 60% of their $3.5 billion in shareholders' equity is in intangible assets, and it's essentially phony. Overall, despite the high revenue growth rates and seemingly cheap valuation, I'm not very bullish on Lightspeed stock at this moment because the company is very unprofitable, they have compressing margins, and a ton of goodwill relative to total assets on the balance sheet. I would much rather own Shopify, which has proven itself as the Canadian e-commerce leader with growing margins and is only behind Amazon in terms of total GMV. All right, finally, the third and last stock I will not be buying on the dip is Intel with ticker symbol INTC. As we can see, Intel is the oldest and most established of all of these companies discussed today, and it's also the only profitable business too. Based on their recent stock price history, Intel is down nearly 30% from all-time highs back in 2021, while they have a trailing PE ratio of only 10, which seems extremely cheap. Not to mention, the company appears to have quite a solid track record of paying and increasing their dividends year after year. However, despite all of these seemingly positive factors, Intel is still not an attractive investment to me, and here's why. Firstly, to be straight with you, the past performance is underwhelming. And although past stock price performance isn't necessarily an indicator of future performance, it does tell a lot about the business and its management. Here we can see Intel has grown its stock price 34% over the past 5 years, which has significantly underperformed nearly every other large cap technology company over the same period. This is a clear reflection of the business fundamentals, where Intel has only grown its revenue from $59 billion in 2016 to $79 billion in 2021, which represents total growth of 33% over 5 years. So do you notice the similarity now? 33% revenue growth and then 34% stock price growth over 5 years. And even when we look at EPS, the results are still underwhelming. EPS was down year over year in 2021 compared to 2020, while over the past 5 years, EPS has grown about 50%. But as we can see here, they had the same EPS this past quarter back in Q4 of 2018, so there honestly hasn't been much growth in earnings at all over the past 3 years. And the only reason earnings have been growing faster than revenue is because the company has been issuing more and more debt to fund share buybacks. Here we can see Intel raised $5 billion in long-term debt while they retired $2.5 billion in this past quarter, and then they use that $2.5 billion to repurchase shares to boost their EPS. In my opinion, this is not an efficient use of capital, and I believe that paying dividends or doing share repurchases should only be done with free cash flow. And that brings me to my second reason why I won't buy Intel stock, and that's because the company is loaded with debt. As of Q4 2021, Intel has $4.8 billion in short-term debt and $33.8 billion in long-term debt. So combined, this is $38.6 billion in total debt, which far exceeds their cash balance of $28.4 billion. And in this rising interest rate environment, the companies that have a lot of debt are the ones that are going to struggle the most, and this is especially true for Intel, where a simple 1% increase in interest rates would lead to an additional $386 million Intel has to pay in interest payments. Furthermore, their cash and cash equivalents of $28.4 billion are essentially equal to their current liabilities of $27.5 billion, which means if the company ran into financial troubles and became unprofitable for some reason, they would struggle to pay off their liabilities. Third and finally, I am not interested in buying Intel stock because they're facing fierce competition from other chip makers such as Apple and AMD. Ever since Apple developed and started releasing their M1 chips, Intel stock hasn't moved. And I believe there's a direct correlation here because Apple was one of Intel's biggest customers when it came to providing MacBook Pros with the chips. Nowadays, Intel can't even compete with Apple because their chip technology is so much further behind, and Apple has made incredible advancements with the M1 MacBook Pros. Furthermore, Intel is also facing fierce competition from AMD, which is another chip maker that's seen its stock rise 800% in the past 5 years, while Intel stock is barely up 30%. Now, I can't speak to the specifics when it comes to the chip technology difference between these two companies, but this does highlight how AMD is adapting very well to the customer's demands in this current market environment, whereas Intel is falling behind. So overall, I'm not a fan of Intel stock because of their stagnating growth, their boatload of debt on the balance sheet, and then their fierce competition from Apple and AMD. Anyways, I truly hope you enjoyed this video and learned a thing or two about value traps in the stock market and things to watch out for when it comes to buying companies on a dip. But let me know in the comments down below what you think of these 3 stocks. Would you buy them, and at what prices would you buy them? So if you did enjoy, make sure to smash the like button for the YouTube algorithm, and don't forget to subscribe so you don't miss any of my future uploads. And with that said, I will see you all in the next one.